So far, in the previous modules, we have learned what exactly is a call option, and in the previous video, we also learned how does payoff diagrams work and look like. In this video, we are going to focus on how does the payoff diagrams looks like specifically for call buying as well as selling. Hi, I am Pranav VK, your option payoff diagram guide in Stockshala by Kotak Securities. A call option gives you the right to buy a stock at a specific fixed price. But what happens if the stock starts moving? That's exactly where payoff diagrams come in. So let's break it down. If you're buying a call option, it means that you're expecting the underlying stock to move higher than the strike price at which you're bought. So let's get to the whiteboard to understand this visually. For understanding this, let's take an example of buying a strike of 200 rupees by paying a premium of rupees 10. So this is the strike and this is the premium. Now our goal is to identify three different metrics. One is our maximum profit, our maximum loss, and break-even point. So let's start with maximum loss. Since in a call option, we would have paid a premium of rupees 10, the maximum loss possibility is rupees 10 as well. So let's first mark that on the option payoff diagram. Here we know that above 0 is profits, below 0 is losses, and let's mark 10 to be somewhere around here. Okay, so this is going to be our loss line. Next, let's also identify the break-even point. We know that the formula for break-even point is nothing but our strike plus premium. So that is going to be 200 plus 10, that is going to be rupees 210. So let's assume 200 starts here and let's say this is 210. And in this case, our break-even counts to here. Our maximum loss is here and this point is called our break-even point, that is 210. Now finally, we'll also identify what is the profit. We know that for a call option, the profit is unlimited to the extent of which the stock prices can go up. So in this case, the profit is going to be unlimited. So as and when the stock prices go up, the profit is also going to be unlimited. So this is how the payoff diagram looks like for a call option contract, for call buy specifically. So let's revise what we have done so far. We took a strike price of 200 rupees at a premium of 10. So we paid a premium of 10 rupees to get into the contract of rupees 200 strike. What was our break-even point? Our break-even point was our strike plus profit, that is 200 plus 10, that is 210. Our maximum loss was to the extent of premium that we have paid to get into the contract. So the worst case scenario is maximum loss of 10 rupees. And finally, the profit is unlimited because for a call option buy, we know that the profit is unlimited and to the extent of how much the stock price can go higher. As the stock price goes up, the profit also goes up infinitely for call buying. And that's the magic of call buying. But remember that the probability of profit is still very, very less for buying options, and that is less than 33%. Now that we have understood how the payoff diagram is for call buying, now let's move ahead and understand how it is for call selling. Now let's take the same example that we did earlier, but in this case, instead of a buyer, now you're a seller. You have sold the same rupees 200 strike at rupees 10, which this time you're receiving a premium of 10 rupees, whereas as a buyer, you are paying the rupees 10 premium. Now let's start with the break-even point because that is the easiest. So now as a call seller, you have received a premium of rupees 10 and the strike price is 200. So the break-even point formula goes like this. It is nothing but your strike price plus premium. It is the same way for even call buying as well. So here it is 200 plus 10, that is going to be rupees 210, which is going to be our break-even point. So let's start marking on the graph. Let's say this is 200 and this is 210. The break-even point is 210. Now that we have understood the break-even point, now let's calculate the maximum profit. We know that for call selling, the maximum profit is to the extent of the premium that we have received. So in this case, it is rupees 10. So it's a pretty straightforward one for us. So let's mark 10 here. And until the break-even point, so that's how your maximum profit is going to look like. And finally, we'll calculate the maximum loss for this specific option. We know that for a call option sell, it is unlimited loss potential. So higher the price of the stock, then higher is the losses. So let's start marking that as well. So once it crosses break even, the loss also starts increasing as in when the stock prices increases. So now we have the complete option payoff diagram for call selling. Now let's say, for example, our specific stock price stops at 205. In this case, what is going to be our option payoff diagram? So let's look at this. So here we have the maximum loss, 200 is here, 205 let's say is here. In this case, this specific point is going to be our profit at 205. But how did we arrive at this? We can simply calculate the intrinsic value for call option selling, and that is nothing but your intrinsic value equals our spot price minus strike price. So spot price is the price of the underlying asset at this specific point, that is 205, minus the strike price that we have chosen is rupees 200, that is 200. So the final intrinsic value is rupees 5, which is also our profit in this case. So this value here is going to be rupees 5. You see, looking at the option payoff diagram, you might be wondering that the profit is only limited whereas the loss is unlimited. And this is where most retailers and beginners confuse and only do option buying. But more important part is the probability of profit. As an option seller, you're winning 2 out of 3 times, whereas as an option buyer, you're winning only 1 out of 3 times, which means the probability of profit for an option seller is 66% by theory and more than that in real life. Now let's head to the screen and look at some live positions and understand the payoff diagrams on the real chart. So now we are on the Kotak Neo platform and I've opened up the strategy bot where you can look at the option payoff diagrams for the various option strategies. To start with, I have considered Nifty 50 to be the underlying asset, and here I have taken a position of 25,150 call option, and let's consider the present LTP is around 30 rupees. In this case, let's look at the maximum profit, maximum loss and the break evens, which is our most important metrics. So here our maximum profit is unlimited. So as you can see, the maximum profit is unlimited as and when the price increases. And the maximum loss is to the extent of the premium that is paid, that is 1961, which is basically 30 into the lot size. So on the negative side, you can see that the maximum loss is minus 1961. And finally, the break even is 25,177, right? So that is also visible here to us. That is the break even. Now here is the beauty. All I have to do is click on this B button and it will automatically shift this into a selling position. And the moment I shift from a call buying position to a call selling position, you can see that the graph went exactly opposite to how it was looking like for call buying. Let's do that once again. So if I do it buy, you can see that it was looking like a hockey stick. But whereas if I do sell, it is the exact opposite. Now let's look at the maximum profit, maximum loss. So the maximum profit here in this case is 1961, which is to the extent of the premium received. On the other hand, whereas when we were doing call buying, this was our maximum loss. So here you can also understand that this is a zero-sum game. If a buyer is making profit, then that is the equivalent loss that the seller will be making and vice versa. For option selling, the max loss here is also unlimited, right? So here you can observe that as and when the call option price is going higher and higher, the loss is also higher and higher. And finally, the break even remains the same at 25,177 because the formula for break even, whether it is call option buying or selling, is same. So let's do a quick recap of what we have learned so far. We understood that call buying, selling, put buying and selling can be visually shown on a payoff diagram, and that will help us decide whether to go for the trade or not. And most importantly, we understood that zero-sum game. What exactly is zero-sum game? It is where the profit made by the buyer is equal to the loss made by the seller and vice versa. So that's a wrap on call option payoffs. Moving forward in the upcoming video, let's look at put option payoffs and understand them better. Like this video if this made it more clear about call option payoff diagrams, and share it with your friends. You're watching Stock Shala by Kotak Securities, and I'm Pranav VK, and I'm going to see you in the next video.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.